e ngā rangatira o te motu tēnā koutou katoa. Tēnā tātou te hongi e hoki mai ki tēnei rā tuarua. A kia koutou ngā tāhau kia haere mai I raro I te karanga o tēnei kaupapa nui. He aha te mea nui I te ao, mako e ki atu, he tangata, he tangata, he tangata. Kia ora tātou, ko maua o te maunga, ko te awa te kairangi te awa, no tauranga moana aho, ko Davie tōku whānau, ko Yvonne tōku ingoa. Morena, and welcome to day 2 of the main platform for our Financial Services Council 2021 conference, ReGenerations, Reimagined. My name is Yvonne Davie, Manager, Super and Savings at Craig's Investment Partners, and I'm delighted to be your MC for today's proceedings, the final day of our conference. We have a fabulous lineup of speakers that will showcase key political, regulatory and industry leaders exploring the big issues facing our sector and people. So I encourage you to get comfortable and settle in for a great second day. Firstly, I'd like to welcome back those of you who have joined us online yesterday and possibly over the past 6 weeks on our specialist stream sessions, and a warm welcome to those of you who are joining us for the first time today. This conference is our flagship event on the FSC's annual calendar and one not to be missed due to its leading edge content and speakers that has sparked much engagement and debate. Our 2021 ReGenerations conference builds on previous themes of wellbeing, sustainability and guardianship. The Māori whakatauki He Waka Eke Noa builds on these themes by highlighting the importance of recovery and going forward together in both good and trying times. And I'm sure you will agree that we have faced some trying times again this year as we faced into the challenges of the Delta variant hitting our shores and navigating through those choppy waters. With a literal translation, we are all in this waka together. This whakatauki centres in meaning around our whānau and community, being on the same journey, headed to the same destination, and leaving no one behind. It seems appropriate at this time to give a big virtual high five to show our gratitude for our fellow Aucklanders who have taken it on the chin, bearing the brunt of the COVID-19 lockdown and restrictions for our fellow Kiwis. Ka rawe te mahi. In our industry, we all share not only a duty and a responsibility to our customers to help them have better, more secure financial futures, but also a responsibility to look out for our colleagues, our friends, and our whānau's well-being. This year, much like last year, has been a challenging one that has tested our resilience and resolve. But I'm sure you will agree that as an industry and a country, we can be very proud of how we have supported our teams and our customers and what we have achieved so far. We are stronger together. Our specialist sessions over the last 6 weeks have covered a wide variety of topics, with reflections from the regulator, panel sessions on the future of financial advice, the big themes and issues for workplace saving schemes, a discussion on how New Zealand businesses and regions have navigated the COVID-19 pandemic, and many more thought-provoking sessions. Kicking off our main conference yesterday, we had concurrent breakfast sessions on the future of regenerative medicine and 3D printing, and panel sessions from Women in Super and representatives from the trustees and supervisors sector. We then moved into our main plenary format with keynote sessions, including a fireside chat on the challenges and opportunities facing the tourism sector, a panel discussion on diversity and inclusion, and of course, an address from the Deputy Prime Minister, Grant Robertson. Today's lineup will be no different in terms of quality and content from our industry experts, politicians, regulators, and thought leaders, and of course, a closing keynote address at midday with Mitchell Pham, Chair of the Digital Council for Aotearoa and co-founder of Code HQ. Excuse me. Now, before we get into the meaty stuff, I'd also like to take a moment to thank our sponsors, who are many and varied. Without your support and engagement, an event like this simply would not be possible. I'd also like to remind you of our charity partner, Voices of Hope, who aim to create and implement change for mental health while providing hope through the voices of those with lived experience. If you would like to donate to this very worthy cause, I would encourage you to visit their fundraising page on their website. And don't forget to check out our Tech Alley partners on the conference portal. There is some great content for you to view and engage with. Thankfully, one of the advantages of an online conference is that we don't need to waste too much time with the more mundane housekeeping issues. I'm sure you're all aware of where your restrooms and fire exits are in the event of an emergency. Also, please don't forget that you can get involved in our live sessions by posting your questions using the Q&A option on the screen. Our main plenary program today will run through to around 12:45, 1 o'clock, and then we will break until 3:30 p.m. for our afternoon sundowner sessions. You have a choice of 3 concurrent panel sessions, from Whose Claim Is It Anyway, to Better Customer Service Through Better Systems, and a look at a real cyber attack case study discussing the importance for businesses being cyber resilient. Right, let's get this show on the road. I'd now like to hand over to Richard Klipin, CEO of the Financial Services Council, to introduce and facilitate our first keynote session with Geoff Bascand, Deputy Governor, Reserve Bank. We are very privileged to have the Deputy Governor join us today, and we look forward to hearing his thoughts on the macroeconomy and the RBNZ's regulatory approach, amongst other things. Richard will, of course, be known to many of you as the face of FSC and all-round good guy and utility player doing the mahi to bring all the strands of our rich and talented sector together. Over to you, Richard.
Kia, thank you, Yvonne. Morena, and good morning to everyone who's joined us for day 2 of the conference, and a big shout out to Yvonne and, in fact, Vanya yesterday for running the main platform and emceeing so beautifully. It's great to be a utility player, so thank you for that. And for this particular session, a very warm welcome to Deputy Governor of the Reserve Bank, Geoff Bascand. This session is a key one for a number of reasons. It's Geoff's final session for the FSC community. It's also Geoff's final presentation to the marketplace more broadly, and it's a great way to pay tribute to the work and the mahi that Geoff has done, not only in our sector, but more broadly in his role as Deputy Governor. So delighted that we could host the session. Geoff, we've had many conversations in camera and together, and this one will be great, notwithstanding the fact that you're in Welly, I'm on Wahiki Island, and we've got people beaming in from right across the country. Folks, this session will be interactive, a little to Yvonne's point. In other words, Geoff is going to say a few words, and we're then going to have a discussion. Encourage anyone and everyone with a question just to use the chat bar. But look, Geoff, over to you. Geoff doesn't need any introduction formally, other than to say he's been a great steward in his role, very engaged and accessible to the sector as we've kind of fought and walked many paths together. Notwithstanding COVID over the last 2 years has probably been some of the most intense and challenging times. So with that, welcome. Let me hand over to Geoff for his opening comments. Geoff, welcome.
Tēnā koutou katoa. Thank you very much, Richard, and for those words and the opportunity to speak with you today. Let me start by saying that the relationship with the Financial Services Council has been truly enjoyable, fruitful, and I think indicative of really a maturing of relationships between the bank and the financial sector. I really appreciate the proactive, constructive engagement from FSC, from Richard and Rob Flanagan in particular, and facilitating many opportunities for engagement, and we value those. I value this opportunity to provide some reflections. I hope we'll have plenty of time for questions. I've got 5 messages I want to leave today, so let me just summarise those at the start and get a sense of what I'm going to talk about. First is about macroprudential policies. I see these as here to stay in the many years ahead in one form or another. I think they may alter somewhat, and I'll touch on that. Second message really is that calm economic conditions are rare, and hence economic resilience is key. However, we're a long way through the resilience focus in our regulatory settings. It's more about maintaining it than lifting it further, in my view. Third message, we in industry are still bedding in a risk management and strong governance uplift. I think there's still work to do there, but I'm pleased to say that attitudes have improved a lot, and we're in a cooperative, constructive way forward in doing that. Fourthly, I expect that efficiency, innovation, industry dynamics and technological change are going to be much more prominent topics in the next 10 years, and will really challenge industry and the regulator in adapting to this innovative world that we're embarking upon. And then finally, just to note that the Reserve Bank itself is facing a large amount of regulatory legislative change, and this will take time to bed in, and we'll be working with you as all of those changes in our governance model take effect. For the dedicated amongst you, my fuller remarks are being released on the website, so you can get to read those. I just have to pre-see them here. Let me start by saying it's been a privilege and a blast to be involved in significant monetary and financial policy making, decision making over the last 8.5 years. I was going to say during these extraordinary times, both Yvonne and Richard have already touched on the pandemic, but one of my central messages today is that we have to get used to the reality that booms, busts and dramatic events are more the norm than the extraordinary. I was just thinking about the near misses that we've had with SARS when we had it. M. bovis, it wasn't foot and mouth, thank goodness. But, those things there. And of course, I came into the bank in 2013, having just delivered the 2013 census that was postponed after the 2011 Christchurch earthquake. Apart from its tragic human toll, that seared, of course, on the insurance sector's memories. One of the many events that we confront. 2013 was also the aftermath of the GFC, when central banks were reflecting on the monetary and financial stability policies and how to avoid another financial crisis. Domestically, our housing market was surging, with loose lending standards seeing greater than 20% of all outstanding mortgages having LVRs over 80% at that time. The Reserve Bank became a fast follower of the emerging international practice of macroprudential policy. So the role and interaction of monetary and macroprudential policy has been a key feature of the past decade, and it looms just as large today as it did back then. It's really challenging getting macro-pru policies understood and setting them in terms of costs and benefits. But I am a believer that they redress the inherent tendency of banks to be pro-cyclical, underestimating credit risks when asset prices are rising. However, they won't fix the housing market, and nor should they be expected to. We can lean against house prices by increasing the cost and restricting the availability of credit, but we can't alter the supply of land and buildings. The Reserve Bank has an impact on the housing market, but it can't be held responsible for it. Our job is to limit the financial stability risks that arise from unsustainable house prices, and to keep overall inflation under control. So I think macro-proof policies will remain a very important policy tool in the years to come, but how much they'll be applied in a temporary manner, or perhaps even in more permanent policy settings, will be a future topic for future policymakers. Next point I want to make was that, and again, Yvonne sort of touched on this, on troubled waters, New Zealand economy, and I was going to use a seagoing metaphor, the New Zealand economy is a small boat on a turbulent global sea. The single most important thing a central bank can do is to ensure the economy, and in particular the financial system, is highly seaworthy at all times. This means building resilience, maintaining private sector and public policy buffers that can be drawn on when required, and having enough policy flexibility to be able to exercise policy tools settings when required. I think we are in a situation where we need to rebuild some monetary and fiscal policy space, not urgently, but over the coming years. Our decision to lift banks' capital requirements was, of course, a major step forward in this resilience drive. I'm not quite sure whether the capital review was a highlight of my time here, but it was certainly memorable and I think worthwhile. There's still considerable work to do with the insurance sector and a broad policy regulatory arrangements, but its risk setting seems sounder, and I think we've got less challenge in terms of lifting resilience, more just about managing affordability, risk-based pricing, and avoiding shifting risks to government. Intensifying our regulatory pillar, of course, has been quite a strong focus of recent years. Most of you who know me well will know that I'm a fairly market-oriented economist, meaning a desire to put weight on market discipline and self-discipline. Unfortunately, there have been too many instances where these have been found wanting on their own. CBL's demise was, of course, a defining episode in our regulatory approach. Had failures in both market discipline, in all of market discipline, self-discipline, and regulatory discipline. For our part, that corporate failure marks a threshold change in our supervisory attitude. We've learnt and determined to act more proactively, more quickly on suspicion of inadequate risk management, having the confidence to act and demand prudence before a crisis unfolds. Our review of banks' attestation processes revealed significant weaknesses in board governance processes, and sadly, continued identification of historic compliance issues continues to testify to the need for firms to lift their positive assurance processes and investment in systems and compliance. As I said, I've seen real progress in the attitude, and I think positive assurance processes are improving, but the planned governance thematic review, I think, will be an opportunity to learn the best practices and reinforce these expectations. Perhaps more than anything I'm proud of is that through this increased intensification of scrutiny on the financial sector, demanding better governance and compliance management, we've actually forged stronger relationships with the industry. And so I think that one can do it in a constructive and a collaborative manner. Just a few remarks on the bank itself and its governance model. The Monetary Policy Committee, established in 2018, has proved, in my view, a very excellent development. It's consolidated what was an emerging collective decision-making practice, but strengthened transparency and the integrity of our policy deliberations. Looking ahead, the bank faces significant governance changes, with the board being made responsible for all the non-monetary decisions, and the board comprising 4 to 8 non-executive directors plus the governor. Coordinating monetary and financial policy decisions is really important. It's one of the things that governors are fixated on, is how do we make sure our macro-pru, our financial policy, our monetary decisions all work together to support the economy and to support the financial system. It'll take great discipline and skill for the board's governance model to work to maintain operational independence and effective coordination of decision-making across the different bodies. So I hope the board works appropriate at the governance level and follows the bank's best governance advice. Very quickly, just last thoughts on where to from here. Look, there are always new and emerging risks. Central bankers are paid to worry and to think about the risks that are emerging in the future. Cyber risks and climate risk require deep understanding. While risk management is the forte of financial institutions themselves, understanding how these risks accumulate at the system level will be underpriced due to implicit government guarantees is an appropriate focus for the central bank. And without further analysis, we simply don't know how serious these risks are. So we need to address that. Obviously, I think these risks need to be seen as an and not an or. We have many traditional forms of risk: market risk, liquidity risk, solvency risk, operational risk. So it's not climate risk or cyber risk instead of, it's in climate and cyber risk as well as these other risks. The strengthened cooperation amongst regulatory agencies, COPA, is a really important development. I think this helps to keep a broad and balanced focus on efficiency, customer outcomes and financial stability, and I trust that will be a really important dialogue in that forum. As I said, I think the future, the next 10 years, will have a strong efficiency focus. I think payments and central bank digital currencies drive that in many ways. They hold significant challenges for central banking. They're more than just a technology change. They potentially, impact the banking system in ways that are not yet understood. So we're going to need to think our way through that. So I guess that's just a note to say that our work's never done. There's always risks and change on the horizon. What I'd like to say is that our financial stability approach has strengthened, the foundations are more solid, and most of all, our broader sector and industry engagement stands us in good stead to keep learning from one another. I'd like to thank my team, colleagues, for their shared endeavour and the wisdom I've gained from them and I've had with them. Thank you for the opportunity.
Many thanks, Geoff. And yeah, look, you've got very sensitive microphones over there at the Reserve Bank. And if I could request perhaps you move the paper away from the mic, that'd be awesome. And that's brilliant. And we're going to get into a bit of discussion. Geoff, first question. The New Zealand economy seems to have been very resilient coming out of, not that we're out of COVID, but kind of bouncing as we've gone in and out of lockdowns. Has that surprised you?
Well, we certainly were very uncertain about how businesses and households would respond. I think, so in that sense, yeah, that was really unknown. These are coming out of something where you've locked the economy down for some months, as we did last year, or weeks, or months as well in Auckland this year. Yeah, it does leave you unsure as to how people will respond. I think it's really encouraging that we did bounce back. I think longer term investment's still a little uncertain. We were starting to see that come through earlier this year, but of course, the global uncertainty remains. So, yeah, broadly speaking, we're very encouraged that there's been some resilience there, and I've touched on that. As I think the business sector's proved, supported, of course, by all the wage subsidies, but basically balance sheets are in a better place than we expected. Households, some of them have got a lot of debt, but a lot of them have also benefited from house prices and generally speaking have saved reasonably well through the last year or so. So yeah, we're in a state where we can bounce back, and let's hope that it keeps progressing well.
Because at the last session, you and I were talking about the resilience of New Zealand's households and families, and the FSC had been tracking this through our Financial Resilience Index. But similarly, the feedback on outlook on things like jobs and just general confidence seem to be not overly buoyant, but pretty strong nonetheless. And then we've had this kind of huge boom in asset prices, particularly property. I mean, how does that paint for you, the next 12, 18 months in terms of how we come out of what hopefully will be the COVID era?
Well, the labour market's incredibly important. I mean, most people rely on their employment income for the great part. So more than anything, the fact that we avoided a really large or long-term rise in unemployment has left households in a much better state. So job security is better. We've actually seeing people, moving to better jobs. So that stands us in good stead. We are seeing it at a very tight labour market. I think obviously restrictions or hard to get immigration through in these circumstances has meant businesses have been short of labour in many ways. So yeah, I think there's some good demand for employment there, and the opportunity basically for many households to keep moving forward and with confidence. It's not to say it's all good. There are obviously pockets and places of unevenness, and that makes us a bit cautious. Hospitality sector's done it hard. Retail, of course, is doing it pretty tough. So yeah, I guess I always want to look for the shadow in these pictures as well, and just make sure that we have a balanced view of how things are. But the broad picture is pretty encouraging, I think.
Yeah, there's been a number of sessions over the last couple of days around the tightness of the labour market. Just can't find people for love nor money, so there's a lot of movement. Otherwise known as the Great Resignation. I mean, how do you see the labour market and the tightness of the market playing out, particularly when borders are, like you say, all but closed?
Well, I mean, our MPS projections still have a pretty strong demand for employment, unemployment remaining low over the next few years. So, that's a central projection on the assumption that the economy, we don't get another really severe health shock. But if those conditions remain, we do think we're in a pretty good place for employment to, as I say, remain strong, for wages to rise, and the economy to keep growing. So those capacity constraints create a bit of inflation pressure. If that picture unfolds, I think the bank will continue to look to reduce the amount of support that it's providing. We should be able to ride through in more neutral settings than ones where we're doing a lot to prop it up. So I think that's the central path. But I guess the opportunity we have is to keep making decisions, to keep seeing how the data plays out. I think the next few months, just seeing how households do respond to the changes in mobility restrictions, the way the health circumstances play out, is just a time to watch carefully, really. And I think the next few months have that degree of uncertainty that says just be a little cautious and watch and take considered steps.
Do you think, just on that inflation point, do you think the spike in inflation seen through house prices, tight labour market and so on is maybe the next 12, 18 months and then will moderate, or do you think we're in for a period of sustained kind of inflationary pressures?
Well, I mean, we're leaning into it and intending, if the conditions unfold, as I said, on our projections, then we will keep reducing stimulus. So we're going to do our part to try and lean against inflation getting momentum in it. It's definitely got some persistence for the next 12 months. We'll see CPI still moving along at perhaps 4% over the next year, but we think it will moderate over time. Some of those things that have driven it up won't keep rising forever. You don't keep raising dramatically shipping costs and other raw material costs forever. They go up and a level and then hopefully moderate. But on the other hand, there are wage increases and rates increases and housing prices still coming through. So a picture that that we need just to lift interest rates a bit and help to bring it back down through second half of 22, 23. I don't fear a wage price inflation spiral, if that's what you're talking about, the hallmarks of the 80s. I think central banks are pretty determined, including ours, just to lean against that. It's just a period of time of slightly higher inflation for a while.
No, great, thank you. Just you mentioned that point around doing the census in 2013, having just come out of the Christchurch earthquake, just following on from the GFC, and now slap bang into the middle of a global pandemic. What are your observations on managing through crises that, when we're at uni, we probably didn't go to the handbook class of how to manage in a global pandemic crisis, but in your tenure of your various roles, you've really faced into some serious big challenges. What's your reflection on that?
Well, I think the central remark is that we just have to get used to the fact that there are a lot of these variations, and the world has a lot of shocks in it, and so we need to have enough buffers. It's a story for a household as well. You ideally try and have some savings so you can get through if you lose your job temporarily and you need to find another one. It's the same story for economies as a whole. We need fiscal settings that we can use when we need to. The earthquake, it was an enormous drain on the country's resources, both private and public. Pandemic government's ability to use the wage subsidy was a tremendous part of our recovery because it had fiscal space. You need to be able to reduce monetary policy, so you need policy room. So we want to get policies back to levels where, as I say, they can be used again if we have another shock. That would be, and I think it's not urgent that we have to suddenly consolidate fiscal policy right now. But you look ahead over the next 5 years, if we don't do that at some point, then we will run out of room when ageing takes more impact on the expenditure side of the budget. The bank itself will need to probably reduce the balance sheet, get interest rates back to a more normal sort of level so that we could always cut them again if we needed to. I think those sort of tenets are my main points.
Yeah, I mean, it feels like the notion of risk, whether you're a family, a business, a central banker, politician, the notion of how you manage risk, how you think about risk has become much more part of how we personally have to navigate through really everything, isn't it?
It is, and that's a big part of why we put the capital buffers up for banks. You don't want anybody running right down to the wire and then, having the AMI problem we had in Christchurch or whatever else. You need institutions to be able to withstand shocks. I think the fact that the banks have been building up their capital levels in the pandemic just really reinforced this, is you just need those there if these things come along, and then you can keep lending, you can keep operating. If you don't have that, the banks will screw the credit down. They'll try and protect themselves by stopping lending to anybody else. So, strong supporter of strong capital buffers and good risk management, as you say, in a broader sense of looking at all the things that might happen. That's why we do stress tests, to think about what risk could come that we need to have resilience to. There's climate risks, cyber risks. I don't know where the next risk will come from. I'm not sure we can predict the next one. All we know is that there will be another one, extremely long drought, or maybe we'll be unlucky and 2 or 3 things happen at the same time. That's the really severe scenario.
Yeah, it certainly feels like all of us have become a whole lot more resilient and managing multiple things and so forth over the last couple of years. Geoff, a couple of last questions. You pointed in your set remarks about the raft of reg reviews and change that's come through. There's one on the table right now, which is around the future of money. And I was just kind of interested, just as a personal user, I can't remember the last time I actually used any real cash, but, these are all just numbers that sit on digital platforms and so on. What do you think the future of money looks like for New Zealand, notwithstanding the fact that there's obviously a consultation out?
Oh, it's a fascinating question, and that's in many ways the discussion we're having with the community is what does it look like? There's a great diversity of circumstances out there. Some people budget with cash only. That's the way they manage their household circumstances. Some of the rest of us use credit cards to pay things and try and pay them off straight away. Others, all sorts of electronic payments, and then we've got lots of innovation going on. So, look, I think central bank digital currencies present the biggest challenges long term. I think the demand to avoid money becoming a private thing, which is just done through, it's almost like an old form of barter. You use your payment card, I use my payment card, and we swap them and we do things. I think there are challenges in that for a central bank in terms of control of the financial and monetary system. So, that's what central banks are thinking about. The solutions themselves have a lot of challenges. If we start being in the banker to households, what does that mean for the bank's role? So, at the moment, I think we're in a world where we're going to see multiple forms, hybrid forms. But so I don't have any quick answers for you, I'm afraid. I think it's a real dialogue and a huge investment in research and understanding how to go forward in this world. And what we need to do is be prepared to be customer focused, if you like. It's a horrible phrase, but I mean, think of all the people and how the way they want to do these things. How do banks provide services to people who aren't digitally able? How do they work in remote regions, vulnerable customers? How do we work in a world where we don't want to actually be bankers to households, but we need the credibility of our monetary system to be protected? So, that's the focus for the next 10 years.
Yeah, interesting. We've just finished a competition for kids in schools entitled "Why Does Money Matter?" And so we asked the school kids of New Zealand that question. Some fantastic responses, but you overlay the what does money actually look like? The currency piece, the thing that you hold or don't hold. It kind of almost changes the nature of the question, and literacy, financial literacy, becomes such an important conversation. Mm-hmm. Geoff, my very last question for you as you leave your role, what's been the most satisfying thing as you reflect and as you depart your role over the last several years in your current role?
Oh, well, I think it is the relationships with the sector. So I don't say that just because I'm on the screen with you folk, but genuinely, I've really enjoyed that engagement, and I'm very proud that most recent survey we did showed that there was great respect from the sector for the work that the Reserve Bank's doing. So I think that's the foundations for how we need to continue to go forward. We don't live in a little isolated, cottage on the terrace. We live right out there with the business and financial sector, and in terms of talking with them. So I'm really proud that those lines are well and truly open, and there's constructive relationships. So thank you.
No, thank you, Geoff, and certainly reflecting on the time we've worked together, that's exactly right. The Reserve Bank's come much more into the conversations and the key ones happening in the sector in a very constructive and engaged way. So on behalf of certainly the FSC board, a huge thank you. We have a more formal thank you, and so I'm going to hand you back to Yvonne and a much more formal thank you. And again, really appreciate your time over today and over the many years we've worked together. Yvonne, back to you.
Thank you, Geoff. Thank you, Richard. What an informative session, and really great to have your contribution to our program today. Geoff, we appreciated you reminding us that the role of the RBNZ is not necessarily to fix the issues with the housing market, but rather ensure the economy and the financial system is seaworthy at all times, and for sharing your thoughts on the future of money. To give a more formal vote of thanks, I'd like to welcome Tim Williams, partner at Chapman Tripp, and a member of a few FSC committees, including the Regulation Committee, So thank you, Chapman Tripp, for your sponsorship of the session, and welcome, Tim.
Thank you very much. It is a great privilege to be able to thank Geoff for his presentation, informing us, as always, with his insights into the thinking of the Reserve Bank and its policy objectives, and commenting insightfully on the monetary and fiscal position of the economy. And also to have the opportunity to acknowledge Geoff's tenure as Deputy Governor and General Manager of Financial Stability at the Reserve Bank, with him retiring obviously in January after 8.5 years in those roles. Geoff's contribution as Deputy Governor over that time to the banking and insurance industries can be measured by his many achievements, including building sector relationships, stronger relationships with the sector, I should say. He mentioned respect, and I think that's absolutely true as well, and communicating greater governance, conduct and culture expectation on the participants in the industry. Governor Adrian Orr acknowledged Geoff's incredible contribution to the Reserve Bank and recognised his leadership in governance and wisdom. Geoff will leave a lasting legacy at the Reserve Bank as it goes forward. And it's appropriate to also mark Geoff's considerable longer public service record, including being chair of MB's Audit and Risk Committee, the government statistician and chief executive of Statistics New Zealand for 8 years, and before that, general manager of Labour Market Policy Group and the Department of Labour. I've had the privilege of knowing Geoff over the last 8.5 years, enjoying his company at various events and functions, many of them hosted by FSC, and listening to his many carefully worded presentations while trying to identify points to take issue with, including his economic outlook. Sadly, there weren't many that I disagreed with. He's always spoken clearly, convincingly, and with a notable calmness and certainty suitable for his office. You'd leave one of Geoff's presentations with a little more economic understanding, reassured that the banking market was in safe hands, and any changes would be measured and proportionate. He's really flustered, even when asked as a government statistician by a journalist to respond to Disraeli's claim there's lies, damn lies, and statistics. He managed to come up with a very reasoned explanation that he tells it how it is. I guess that sums up Geoff's career, telling it how it is. So on behalf of us all, I'd like to wish Geoff well for his plans for his future. Thank you, Geoff. The banking and insurance industry should be grateful for your careful stewardship, your clear communications, and willing engagement with the industry throughout your tenure. And I pass back the microphone to Yvonne. Ngā mihi.
Thank you, Tim. Loved your background there. Thanks very much for your word of thanks, and all the best, Geoff, for the future.